70% of all gold production in the U.S. comes from a single state, Nevada. Conventional wisdom says that all the good deposits have been found. But one geologist who's discovered more than 30 million ounces of gold says he knows where to find Nevada's missing gold. And right now, he may be on the verge of being proven right. Investors and speculators can learn more at futuremoneytrends.com/gold. Greetings and thank you for joining us at futuremoneytrends.com. I have a very special guest, somebody I got to meet at the Liberty Symposium back in February, man, I think it was 2013 or 2014 with Robert Ian and Carrie Lutz. His name is Gary Christenson. He's the author of Gold Value and Gold Prices. You can get his work at deviantinvestor.com. I recommend everybody go to that website today, bookmark it. It's one of those websites where you've got this guy who's just relentless and passionate about his original work. I think you're really going to enjoy it because no one else has anything else out there like it. And really, it is from Gary. It's Gary's research. And again, I would recommend everybody also get the book Gold Value and Gold Prices just to kind of understand where Gary's coming from because, again, his research is unique and it is original. Gary, thank you so much for joining us.
Well, very much, and appreciate it. Thank you.
Well, Gary, let's start off with silver. I had jotted down on my notes here where you thought silver could go over the next year. But I know you've been doing a lot of work on just research and silver analysis for 2016 and many more other articles about the precious metal that is everybody's favorite. Personally, my favorite as well. So what are your thoughts on silver for 2016? Because gold has made new 52-week highs. Silver is still short of that.
Well, yes, silver is still short of that because, in fact, it hit a multi-decade high on April 29th, 2011, the 5-year anniversary of which is coming up very close. And at that point, just for people who don't remember, the high that silver made at that point was just under $50. It was about $48.50 on April 29th, 5 years ago. And then after that, the market got absolutely crashed. And this plays into one of the important points in this. I don't want to spend a lot of time talking about manipulation of the market or conspiracy theories or any of that. What I want to point out is that silver is an extremely volatile metal, and you can prove this going back to the 70s. And it goes up way high, gets way too far ahead of itself, and then comes crashing down. Now, certainly the process involves the COMEX increasing margins and other people selling short and so forth. But really, if you filter out all of that and you just look at prices, you can see that it goes parabolic every so often, and parabolic moves never last. And that's what happened in April of 2011, because if you look back at what silver was in 2010, it was down around $20, and then it moves up to $50 almost. That was too much, too fast, and so then it crashed. And the problem with that is that the average investor out there says, "Gee, look, silver's moving. We've got to get me some of that." They get into it, the market crashes. And then they're depressed and disillusioned with it, and then they go buy something like T-bonds or something, and then they've lost interest in silver and they haven't seen the big picture. And if you don't see the big picture on silver, you're really missing out. And the big picture is silver prices have to go up along with, and you can name whatever you want. It's an exponential world because we have exponentially increasing debt and exponentially increasing money supply. And so silver prices are going to go up just due to that. Then on top of that, occasionally they're going to bubble up and occasionally they're going to crash way below their exponential trend. That's what happened in 2011. They bubbled up way above that exponential trend, and now they're way below that exponential trend. And you can argue about where the exponential trend should be drawn, but I think a safe number in 2016 is about $30. In other words, a very long-term exponential trend line through the price of silver for 2016 is about $30, which means it can easily bubble up to double that and easily fall down to half of that, which it did in December of 2015. So my point is, for the short term, it's very hard to predict where silver is going in 2016. My personal opinion is it's likely to go much higher because I think we have significant monetary trauma in the world. I think we have lots of craziness. We have money printing, particularly in Japan and the European Union. I think the Fed is printing a great deal more money than we know. All of these things are going to push the price of silver much, much higher. And I wouldn't be surprised, and this is not a prediction, this is just I wouldn't be surprised thing, if we see silver at $40 and $50 by the end of the year. But I think it's quite likely that we'll see a $50 silver price in 2017, if not 2016. And then if you go forward to 2021, 2022, just based on exponential trends, just based on economic craziness, and just based on looking at the events in the world, $100 silver comes into play. And that's without even postulating hyperinflation and a few $1 trillion coming home, pushing the U.S. economy into hyperinflation. So I'll let it sit right there. Does that make sense so far?
It does, and I can't help but think of what would happen to the mining shares. I mean, silver's up 20%, and these things are up 100 to 300%. Silver to 30. I mean, just in the next few years, my goodness, I can't even imagine what the mining shares would go ballistic. You did mention something after these crashes, where people go into silver bugs, I guess, get depressed. But this bear market was unique in the sense that we never really saw the physical demand let up. In fact, the investment demand for physical silver, despite falling prices, was better than ever, correct?
Well, yes, it was. And Steve St. Angelo, SRS Rocco report, documents this extremely well, I think. And I recommend everybody go look at what he has to say. He does the physical demand and the physical statistics extremely well. And he shows exactly what you're saying. There's tremendous demand out there. And one of the ways you can see that is if you go back to 10, 15 years ago, the premium on Silver Eagles, a 1 ounce Silver Eagle published or minted by the U.S. Mint, the premium was 10 to 12%. And now you look at the premiums, and they're much higher than that, particularly at the crash bottoms. They're 25 and 30 and 40%. And that's just an indication that the paper price of silver on the COMEX has been pushed way lower than it really should be, and the physical demand is still quite strong. So yes, that's still there. And that in and of itself, I believe, is an indication that silver has a lot of room to grow higher because the demand is there, and you can only repress the prices with paper contracts for so long.
Gary, did the Shanghai gold price fix significantly change the price game now? And will this be a benefit to gold and silver finding real market levels?
Well, and this is only my opinion, and I can't quantify it with any numbers, and I want to quantify everything if possible. But I think it helped a lot, and I don't say that in the sense of in a day or two or in a week or two, but I think that in the long run, the real price of physical silver and the real price of physical gold that's going to become more and more prominent in Asia is going to diminish the importance of paper prices in the West. And so I think that in the long run is going to make prices for silver and gold much more real. And given the demand and given the money printing that's involved, those real prices have to be far higher than they currently are.
When looking at previous market bottoms, do you feel confident that gold has bottomed?
Well, I do. And I think this is this is always an important question to anybody that's investing in silver. And let me address that by saying, yes, I believe silver clearly bottomed in December. I believe gold bottomed at the same time. I think those are long-term, what you'd call intermediate or major-term bottoms that we may never see $14 silver again in our lifetimes. That may be the long-term bottom. Now, that's a strong statement, but let's go back and look at, say, 30 years of history. And this is an article I published on March 31. And what I did was I took the price of silver, COMEX silver, published it, put it on a log scale, and then identified the 8 most important lows. If you go back and you identify those 8 important lows, put green circles around them, and then you plot the silver to gold ratio. Now, this is the reverse of the gold-silver ratio. So when the silver to gold ratio is very low, that tends to be silver lows, and when the ratio is high, you tend to have silver highs. For instance, and I plotted this ratio going back 26 years, the April of 2011 high was way out of the trend range. That was simply too high in silver, and the ratio was far too high for the silver to gold ratio. If you go back and plot those 8 lows on COMEX silver prices, and you look at them on that silver to gold ratio, 6 of those hit the bottom trend line. The other 2 are clearly lows, but not as low on the bottom trend line. So if you look at the bottom trend line, you say February of 91, you see 93, 97, April of 2003, October of 2008, and December of 2015, all extremely important silver lows going back almost 30 years. That to me says that the price of silver lows and the silver to gold ratio lows correlate very well. But then let's do 2 more things. Let's take the silver to S&P ratio, find those same lows, and you find that the silver to S&P ratio is at important lows at the same time. So you got all those lows matching up, not exactly, but close enough to show that whether you're going to compare to gold or you're going to compare this to the S&P, you see significant lows. And then go one step further and take the relative strength index, which is just a technical indicator and it's a timing indicator. And you look at that index on a monthly basis, because we're looking at a very long-term scale here, and you find out that all of those 8 lows match with lows in the relative strength index. And those show as tremendous lows in December of 2015. And to me, that's multiple levels of confirmation that that December 2015 low was a major low in both silver and gold.
Gary, last question. I know that you're not an investment website, but you analyze these metals, and I know you're talking to people every day and researching and reading so many articles. And I just want to get your thoughts. And again, for the audience, this is not his advice, but. So I understand the reasons, and I think the audience understands the reason for having physical ownership for preservation and as part of one's portfolio. But just for fun, do you recommend, or do you not? I guess I don't want to pin you down, but do you speculate with seeing what you see in the data? Do you speculate with call options? Do you speculate with the ETFs? Do you speculate with the mining shares? Do you speculate with the big mining share? I mean, how best to maximize this in your opinion? Because it does clearly look like, according to your data and everything I'm also seeing, that we're about to have a big run in the precious metals right now.
Well, yes, I agree. We are about to have a big run in the precious metals. And let me just say that over the course of the last 30 years, I've done futures contracts, I've done options, I've done ETFs, I've done mining shares. At this particular point, I've been, I should say, this particular last several years, I've been rather unenamored with mining shares and with ETFs and so forth, because it's been, frankly, a bear market for gold and silver. I think going forward, we're going to see huge gains in the mining shares, because they're multiples in terms of movement up of silver. Silver will move up 2, 3, 4 times faster than gold, and the mining shares will move up 2 to 5 times faster than the underlying metals. So they're going to be huge moves. I'd also caution everybody that mining shares are some of the most volatile things in the world. So those need to be managed and watched. But I think that you put some of your money into physical silver, some of your money into physical gold, and by physical I mean not an ETF, but have it in your hand or in an off-site storage or something like that. I prefer off-site storage, not in the banking system. And you have some of your money there. You have your speculative money in the mining shares, gold and silver mining shares, and you manage that carefully. And you don't worry about T-bonds, and you don't worry about the S&P index. And you wait, because I think that strategy will be very rewarding over the next 5 years.
Yeah, and the mining shares especially are extremely volatile, cyclical, and if you talk to Doug Casey or Rick Rule, they'll tell you that as businesses, or Doug Casey will tell you for sure that they're horrible businesses in general, and they're speculative bets, and you bet with the right people, but then you've got to get out. These are not the IBMs and the Apples and the Exxon Mobils of the world. These companies are very volatile. So anyone who's going to get into something like that, please be careful and know what you're doing before you do anything. Otherwise, stick with the physical metal. Gary, thank you so much for joining us. Anyone who wants to see Gary or reach out to him, please go to deviantinvestor.com. That's deviantinvestor.com. And you can also check out his ebook, Gold Value and Gold Prices. Gary, thank you so much for joining us.
You're welcome. Thank you very much.